When you borrow money to buy a tech stock in hopes of a price increase, the tax treatment of your loan interest depends on a legal definition of income that many investors overlook. This is misconception number 9 in our series. Leveraged investing has moved beyond professional firms and is becoming common among retail investors. Many assume that the mere act of placing borrowed money into a stock market vehicle automatically creates a legal tax write-off against their other income. However, the law draws a sharp distinction between capital gains and income. Confusing the two is a common error that triggers a CRA audit. Misunderstanding this definition can result in your expected tax write-off becoming an added expense on top of your borrowing costs. Paragraph 21C of the Income Tax Act states that the law is not concerned with where you invest. It focuses on the specific purpose of that investment. The Supreme Court of Canada solidified this in the Ludco decision. The court ruled that to deduct interest, a taxpayer must have a reasonable expectation of income at the time the investment is made. This means the CRA separates your returns into two categories. On one side is income, which includes dividends, interest, or rent. On the other side is capital gains, which is the profit from buying low and selling high. For the purpose of deducting interest, the CRA excludes capital gains from its definition of income. The tax code ignores your total market profit. It only recognizes the specific way that profit is delivered. To see how this works, consider two investors who each take out a $100,000 loan with an annual interest cost of $6,000. Investor A uses their loan to buy shares in a high-growth tech company. Because the company reinvests all its profits to fuel growth, it does not pay a dividend to its shareholders. Investor B uses their loan to buy shares in a traditional Canadian bank. These shares provide a recurring dividend that is paid out directly to the investor. When Investor A tries to claim their $6,000 interest expense, the CRA disallows the deduction. Because there was no dividend, the CRA views the investment as being for the purpose of capital gains, which does not qualify. Investor B's $6,000 interest cost is fully deductible because the presence of a dividend satisfies the income earning purpose test. In the Swirsky case, the court confirmed that a subjective hope that a company might pay a dividend in the future is not enough. You need objective evidence of a dividend policy at the time of purchase. Two identical loans end up with different real-world costs because of the specific dividend policies of the underlying companies. If you face a CRA audit, a general intent to invest in the market will not secure your deduction. The specific asset you choose determines whether the debt you use to buy it is tax-deductible. If you are borrowing to invest, you must verify the dividend policy in the company's prospectus before you buy. Review your current margin accounts closely for any significant holdings in non-dividend growth stocks or highly speculative assets. If you identify a potential issue, consult with your accountant to see how it affects your tax return. Have you reviewed your portfolio's dividend yield lately? Share your thoughts in the comments and subscribe for video 10, where we look at the tax rules surrounding life insurance. A successful strategy requires matching your investment goals with the requirements of the tax code. Ignorance of these definitions is not a deduction.